Welcome back everyone, this is Spencer with Numbers of Finance, and this is a market wrap video for Thursday, March 28th, 2019. Not much to report today. The markets have continued to just be grinding and going nowhere really for a couple weeks now. In fact, taking a look at SPY, this candlestick right here that I'm hovering over, this candlestick was February 25th, 2019. You can see in the top left corner it shows the date. But this candlestick is at the exact same price point that we are at right now, so that means that for over a month now, the price has not gone anywhere. We've gone down, we've gone up a little bit, a percentage point or two, but really the market's not going anywhere. We've been steadfast in our bearish outlook for weeks now, and these days and these weeks where we move up or down a fraction of a percentage point do very little, if anything, to change that bearish outlook. But hypothetically speaking, what would change this outlook? Well, if you're bullish, the most important thing that you need to see is that you need to see this 281 level taken out with conviction, which we have not seen. Now, what exactly do I mean by taken out with conviction? Well, a couple things. A, we need to see a weekly close above this level, and B, we need to see the volume go with it. If we break this level like we did here a couple days ago, we need to see the volume follow through with it to know that it's actually a real breakout and it's not just going to be faded just like this one was. Right now, all we've seen is this continued bears versus bulls fight over this 281 level. And again, we popped it once, and that I attribute very much so to the Fed meeting being released. That was just an impulsive break and it got faded immediately, nothing significant. But until we actually get some separation from this level one way or the other, this is going to be the continued theme for this market. Now, taking a look from the bearish side, there's a couple things that we would like to see. Exact same situation with the bulls. We've just been grinding it out for a couple weeks now in the same price area, and so what we need to see is this price area broken. Maybe it'll show up better if we take a look at the hourly time frame. Yeah. So taking a look at the hourly time frame, there's two price points that the bears want to see taken out. The first one, and the least important of the two, is this reaction low that we've had for the past couple of days now. This is a very near-term price target that we want to see taken out for the bears, and we'll call that right about 277.50. Obviously, everything's give or take a couple pennies, but we want to see that taken out. That should open the door for a move down to the more important reaction low that we had back on March 8th, and this one was at about a little bit above 272, but we'll just call it 272. Very important reaction low. Going back to the daily time frame, if we see this daily low taken out, this March 8th daily low taken out, then that should open the door for a more significant pullback than what we have seen. We did have a pullback here, and it was a couple percentage points, but what we're looking for is a more healthy pullback in the broad markets. Healthy pullback could be anything from here, or it could even be the start of a much larger third leg down. But again, there's been absolutely nothing technically significant developing over the past couple of the past couple of weeks, as much as a month. And so when it comes down to whether or not you think that the bulls are going to win or the bears are going to win, for me, it just comes down to what the long-term charts are saying. Now, right now, there's a lot of long-term. We're talking the daily charts, the weekly charts, and the monthly charts for various significant indices and other assets that are screaming bearish technicals right now. And so that makes me believe that, well, the near term favor the bears until the bulls can prove it otherwise. And so getting into some of these charts, that these major indices that are screaming bearish technicals right now, we've already gone over most of those, but since nothing has happened, I figured I would just highlight them all again. We'll start off by taking a look at QQQE. This is the equal weighted NASDAQ index. For those of you that don't know, QQQ is the major tradable ETF that people use to trade the NASDAQ. It's not exactly a problem, but part of what you get with QQQ is that the top stocks are very heavily weighted, and so in the recent weeks we've seen some of those top stocks perform a little bit in aberration to the way that the markets are moving. So it's fair to assume that QQQE might be a better representation of the tech market right now, and so we'll take a look at this one. And look, you can see it's very clear, the momentum sharply pointing down on the MACD and the RSI, whereas the price has been actually fairly sharply moving in the opposite direction. This is a very strong, very healthy divergence we have here. In addition, it's also coming into a resistance point. Now, it's not an exact resistance point. You can see that the prior reaction high was at 47.50, or pardon me, 48, and this one got all the way up to 48.56. Not a whole lot of significance with those couple pennies difference, but we'll still call that a resistance. Also on QQQE, if you take a look at the weekly time frame, it's not as strong of a divergence, but it is still a divergence nonetheless. We can see on the weekly MACD, momentum still heading downwards, whereas the price was going up and is starting to flatten. Regardless, it is a divergence, and usually the larger the time frame you go, the more significant that the divergences are. Next up, we're taking a look at the VIX Volatility Index on the daily time frame. Again, we've already gone over most of this, and I'll just go over it real quick again. For those of you that don't know, VIX is it runs somewhat inverse to the broad market. So like when VIX is going down, you'd be expecting the markets to be going up. Usually less volatility means a good thing for the market. But right now VIX, it's come down to this very strong support zone that has been a very strong support zone for a couple of years now, going back even further than this chart shows. We came down, got close to the bottom, we had a small pop up, and now we're riding right along the top of that support zone. Also important to note that we have very strong daily divergence, positive divergence that is, meaning that if this divergence plays out, if we see this MACD pop and shoot upwards, if we see the price shoot upwards, what we would expect with an increase in volatility is a decrease or another leg down in the market. So again, just another feather in the cap for the bears for the long-term charts. Again, we have to see it play out though. Until it plays out, we're just going to continue grinding like we have been. And so maybe it doesn't pop. Maybe we break the support zone and we start to head lower. But I'd have to see it to believe it. And that does not mean that it can't happen. It just means that right now it's still in favor of, well, the bulls for VIX, but the bears for the broad markets. And the last asset that we'll touch on in this video is TLT, which is it's a bond ETF for those of you that don't know. The past couple of days we've seen very, very strong buying here. We gapped above this very significant resistance level that goes back a couple of years. Now what does this mean? TLT is not as directly correlated as, say, VIX or even crude oil is to the broad markets. But very near term, it's a representation of where institutional buying is going. And what do I mean by this? Well, a lot of times what will happen is when the institutions, these large institutions that are in charge of millions and billions of dollars of the market and of the money in the markets, if they have fear for the money market, so that we're talking SPY, QQQ, and other individual stocks, what they'll do is they'll put it into bonds. Which is exactly what we've been seeing so far this week. We can see quite a few candlesticks consecutively going up, smashing this resistance zone. That does not bode well for the markets. Now, we haven't seen it yet. We've not seen the markets react to this. It's just another sign. We certainly could. Maybe we don't continue to push up. Maybe this gets faded very rapidly, in which case that is a significant move for the bulls, for the broad markets that is. It would be bearish for TLT, but for the broad markets it would be very bullish. Who knows? Again, the indications are pointing bearish. Now that does not obviously mean that 100% we're going to have this significant healthy pullback or even a third leg down. It does not mean that whatsoever. My main point is that there's a lot of work to be done for the bulls to actually break this bearish case, and it certainly could happen, but we have not been seeing that. Although, to be fair, we have not been seeing the bears follow through with these indications that they have. But I'll leave it there. This has been Spencer with Numbers Up Finance. Until next time, make sure you get your numbers up.